In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. We will cover the latest price development of the company, what is the current market sentiment around it, and more importantly, if you should buy the shares and what would be an optimal exposure and time window. Before today's video begins, if you would like to see more stock analysis videos, please like, comment, and subscribe to my channel for more. Sofi Technology is an online company that provides all kinds of financial services, including personal and small business loans, credit cards, and student loan refinancing. It also operates in the fields of wealth management sector and is looking to acquire additional market share from traditional banks. The major catalyst for Sofi recently has been their obtention of a bank charter from a small bank that they have merged with. This means that within a couple of months, Sofi can expand their existing services and operate with more flexibility to acquire an even larger market share. According to financial analysts from Morgan Stanley, the business model of Sofi is particularly efficient because it attracts customers on the platform with lower fees and better interest rates, and then it can then cross-sell more products to the same customers. Essentially, it's a bit like social media. You know how when people visit those websites, they are themselves the products? Well, with Sofi, it's a little bit like that as well. And because most of its infrastructures are online based, they have the luxury of lowering their fees for a higher degree than other brick and mortar companies, which speeds up Sofi's growth even more. The current expectation for Sofi is that their user base will grow to 5.3 million users, or even more than that, within the next 12 months. We have to remember that there are far more accounts subscribed on Sofi than the current active user base, which is about 2.7 million people. Meaning that compared to other competing companies, there is a massive untapped potential client base for Sofi that is very accessible to the company. The current expectation is that Sofi will be expanding their operating results. by about 150% over the next 24 months. From a price action perspective, the stock is now trading upward from $16 not that long ago to $19, all things considered. The stock is not that much far away from a support zone of $15 in which it has traded for almost the whole year of 2021 except for the summer month. And also, I have to say that the trading volume is also very high. The current average is around 25 million shares a day, whereas the current daily volume is more like 45 million shares. So really, there is huge demand, which is enough to push the stock further. The stock of Sofi is still relatively undervalued in my opinion, compared to the expectation of $25 target by different financial analysts, which will be reflected in future stock upgrades and ratings. From a purely price action perspective, the current price is a bit far away from its zone of value, I have to say, which is more around like $17. But in this case, I think that the fundamentals may render the price action considerations a bit useless or less relevant, because the stock may simply surge from there and not look back before a long time. The resistance level between $24 and $26 is something that we need to look for, because once it manages to go through that region, really the sky is the limit. My recommendation is to keep a position of approximately 5 to 10% of your portfolio in Sofi. The time window in the short term is going to be the next 8 weeks. Essentially, the ETA for the bank charter. But I also recommend to keep at least 20% of your position for the long term, because Sofi's growth potential for the years to come is quite significant. Looking at the current environment, I think that we have to be careful with having exposures in the equity market. The market has been predicted to eventually go through a major pullback or even a recession for more than a decade, and that its future outcome depends on a number of elements. After the QE years and a drastic increase of asset price and the corresponding collapse of their yields, we got to remember that market doesn't equal the real economy that it's supposed to represent, because otherwise the market would have been trading sideways since 2008. And then 2020 saw another big push in asset prices, and this time not just for the blue chips, but also the growth stocks. There are generally two explanations. The first one is that more money has been printed across the world, and because the real economy has been stagnating, the capital entered into the melting pot of finance, and then just kept buying up the price of assets. That was the case for quite a while, but now that the QE has been touching its end in North America and slowing down in Europe, I think that it will stop to play an important part in continuing to keep the asset prices high. But this decrease of new money is partially compensated with geopolitical tension across the world increasing, and the more tensions there are, the more money tends to flow to the US and North America in general, because it is perceived as a safe haven for capital from different countries, especially the ones that are having turmoils or social unrests. One last phenomenon is the attempt of market participants to protect their capital, not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset prices in those sectors remain high, not only because of fundamentals, but because there's a very high demand for their equities. The electric vehicle sector in 2020 has been a perfect example for that. There is no reason to believe that while everybody stays at home, more and more people are going to buy EV cars, right? And yet, this is what the market assumed is going to happen. And once they think that's going to happen, it'll become a self-fulfilling prophecy. Because if everyone buys the shares, then yeah, mechanically it's going to go up. And of course, as long as you're not the last one taking part in this game of hot potato, then everything should be fine. What all these mean for the market is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession is building up after the Great Party in 2020. Recent announcements from US federal officials about the recession in the short term and the economic difficulties accumulating and probably spreading from Asia may all play a part in influencing the financial market performance in North America. All these elements led me to conclude that it is important to keep speculative plays at a reasonable level. So I just want to say that Sofi is not a speculative play per se. A healthy portfolio normally contains a good percentage of its positions in sectors that are not only different, but that are for the most part stable, and of classes of assets that are mostly mature with predictable cash flow, such as REITs, fixed income assets, and preferred shares. The rest should then be invested in growth stocks or to stay cash heavy in the case there is an opportunity to scoop the bottom. Overall, the current environment does make me think that there will be opportunities to average down the cost basis in future. And this is why initial positions should remain manageable so that we can afford the stock price decreasing. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.